What's up, you guys? I'm Dan. This is Frugal Not Cheap. Many people I talk to talk about the funds they might invest in as if they're choosing a horse in a race, as if they're completely separate from the other funds that they might invest in. In today's video, I'll explain why I don't think this way. I've had the pleasure of working one-on-one with many people and couples on their finances over the years, and one thing I've noticed is that certain individuals are really good about having compartmentalized thinking. They can think really hard about one particular decision or action, but somehow be able to make that decision completely in a vacuum from anything that might have to do with any effects that might happen from it. I can hear how this might sound a bit negative, but I can also see how this could be helpful in some situations, especially in situations where you really have no choice and you can't really consider the outside consequences at the time. But when it comes to thinking about one's investment portfolio, I think this kind of thinking is very problematic. Now, I know, and I've certainly heard people express frustration at looking at the long list of investment options for, say, their 401k and just kind of having sort of analysis paralysis or just way too many choices. And it can be kind of tempting to think of decision as, well, we'll just pick a few and, think of them exactly as horses in a race. Hopefully one of these funds is going to perform well for me. The problem with this kind of thinking to me is that, of course, investing isn't a horse race. There are relationships between how different asset classes perform. And rather than betting on individual horses, what we really have is an overall portfolio, just one portfolio. Investing in any new fund or moving funds, sort of reducing one's holdings in one fund and increasing them in another, any of these choices are going to change our asset allocation and the composition of our portfolio. This may sound basic to some, but I've kind of noticed that even though a lot of people understand this concept and the idea, when it comes to the moment of sort of picking their asset allocation, in other words, making decisions about what funds to invest in, then they go back to that compartmentalized kind of thinking. Worse, over time, as they look at the performance of different funds, they start second guessing themselves and saying, oh, well, this fund's not doing well, maybe I should invest more in that fund and this kind of thing. That sounds like performance chasing to me and hopefully does to you, and that's, not always the best way to go. But let's put that to the side for now and just talk about the basics of asset allocation. Actually, the Securities and Exchange Commission has a really good primer about this topic. I've put a link to that in the description below. But the basic idea is that we have to make decisions about what kind of assets and how much of them, what the relative shares should be in our portfolio. These assets can be things like how much cash or how much in bonds. These are debt obligations either from governments or from companies or municipalities. And then also how much we want to have in stocks. That's, basically share ownership in different companies. And then, of course, some people like to do things like, invest in commodities or in, other kinds of odd assets. Personally, I don't like to do that. I find that commodities like precious metals or what have you, I don't know, none of that makes sense to me. I like to sort of own shares or lend money to sort of productive enterprises, I guess is what you might think of it as. Anyway, how do we make this asset allocation decision? Well, sort of the, time-tested wisdom or what have you, the common wisdom is that this should be based on two primary factors, which are one's risk tolerance and also one's time horizon. So the longer the time horizon, then the more it makes sense to take on some risk. It would be really foolish to make a very risky bet when we need the money, say, in a week's time. Whereas it makes more sense to make a riskier bet if we're talking about, 20 or 30 years down the line when we, thinking about retirement or something like that. Or even if it's a down payment from a home, if we have, maybe 10 years, then we might take a little bit more risk than we might otherwise on a shorter term decision. So speaking of this risk tolerance is the next factor. And this is really something that's different amongst each individual. People have different temperaments regarding how much risk they're able to stomach. In my case, I'm pretty comfortable with wide fluctuations in the market, and so I'm currently 100% in stocks. I have 0 bonds. It also makes sense for a lot of other reasons regarding the time horizon I need my portfolio to last and my age as well, if you think about classic retirement. Now, there are some useful investor questionnaires out there that could help a person to inform kind of their asset allocation decision. Both Vanguard and Schwab have such questionnaires on their websites, and I'll put links to those in the description, but I'm sure there are many others out there as well if you do some searching. So how do these assets that I just talked about fall on sort of the risk spectrum? Well, of course, cash is the least risky, right? However, it not only provides zero returns, but if we think about inflation eating away at the buying power over time, then actually likely negative returns, unfortunately. Then a little bit higher on the risk sector, we have bonds. And even, of course, within bonds, within this asset class, there are bonds of varying risk with relatively safe things like US Treasuries on one end of the spectrum, and then more risky things like what we call junk bonds, or bonds issued by companies that are viewed as a larger credit risk, kind of on the riskier end of things. And of course, there's a relationship between the expected returns on these things. In other words, that the riskier bonds tend to pay a higher yield, a higher interest rate than the ones that are seen as less risky. They'll pay a lower rate. Then moving up in terms of risk, we get over to stocks, and of course these have higher risk than most bonds, but they also tend to historically have higher returns as well. And again, within the sort of equity or stock asset class, then of course there are many different kinds of companies. Some might be viewed as a more risky investment than others, depending on your analysis. But anyway, the point is that we have a lot of variation when we look at all of these different things. And so that hits upon the point of diversification. So this is the practice of spreading our money or investment across many multiple assets that hopefully aren't all 100% correlated in order to try to reduce the risk. Basically, we're trying to avoid all the eggs in one basket problem. So one way to do this, if we look at stocks, would be to invest in mutual funds that then invest in a ton of stocks rather than just investing in a few individual stocks, which is probably quite risky. And then we can also diversify across asset classes by not only holding stocks, but also holding bonds, maybe some cash, what have you. But that's not all. There is another dimension that we can think about for diversification, and that is by geography or kind of by country, really. So we have to make the decision of, do we want to invest 100% within our home country? Do we want to have exposure to foreign stock markets or foreign bond markets? I made a video some time ago where I had moved my allocation to 50-50 US international. Since that time, I'm moving back towards a market cap weighted structure. So in other words, it'll be 60% US and 40% international. And I'm doing that kind of slowly over time. But in any case, most of the experts out there, again, I'm not licensed to provide any kind of investment advice or anything like that. This is just my thoughts on the matter and informational, and do what you want, do your own research. But most of the experts that you'll find will be suggesting some kind of international exposure, even if it's just say 20 or 25% or something like that, in order to diversify a little bit and provide better risk-adjusted returns. Because at times when the US market's doing very well, for instance, international might be underperforming. That's been the recent trend. But there are, of course, other times where international markets have outperformed the United States, and it might be good to have a little bit of exposure to that. Next, we could also think about diversifying across sectors or even the size of companies. In other words, I know a friend of mine is really heavily invested in the tech sector, for instance, whereas someone else might be invested more in basic materials or healthcare or something like that. And then the other dimension, again, is the size of the company. So there are some indexes that invest in small cap funds, small cap companies. So in other words, ones that have a smaller market capitalization. There's also mid caps, kind of the medium ones, and then the large caps, which are the names you're familiar in the S&P 500. These are the 500 largest. And then, of course, we have, that same consideration for international equities. Now, personally, I don't get into thinking too much about sector weights and all this kind of stuff. What I like to do is basically my philosophy is I don't know who the winners are going to be, so I buy the whole market, and I've got another video you can check out if you're curious about that. And lastly, we have the topic of rebalancing. So obviously, after a period of time, some of our asset classes are going to be outperforming others, and it can be very tempting at this time psychologically to want to bet more on the quote-unquote winners and less on the quote-unquote losers. But this would be exactly the wrong thing in terms of maintaining our asset allocation or the composition of our portfolio. Not only that, but there is a phenomenon called reversion to the mean, which might suggest that continuing to bet on those winners and not divesting from the losers might be exactly the wrong thing to do. So personally, what I do is I rebalance once a year and just get back to my intended asset allocation. What that will mean is selling a little bit of the winners and buying more of the losers and getting back to balance. Now, one reason that with a lot of people that I talk to, they end up selecting target date funds is because those funds end up doing all of this thinking for you, including the rebalancing. So for instance, if you look at Vanguard's target date funds, they will be diversified across asset classes. They have some cash, some bonds, and also some equities. And then the relative proportions of these things, sort of the amount of risk represented in the portfolio, is related to the time horizon, in other words, the target retirement date, where the risk declines as we get closer to the retirement date. And then also they're invested both US and internationally, and they also rebalance as well. So all of that's kind of taken care of. And in the case of Vanguard, the expense ratio or the fees for the fund are relatively low. It's not an endorsement for Vanguard. I'm sure there's other target date funds out there that are good that have low fees as well. But one thing to be careful of is the fees because other options have higher fees for these target date funds. Definitely something to watch out for. Okay, great. So you've got all this knowledge about asset allocation. How do I go about figuring out what my asset allocation is? Maybe I really just did the horse picking thing and I've got a bunch of different funds in my portfolio and I don't really know what my portfolio looks like as a whole. Well, personally, I use a software called Empower's Personal Dashboard, formerly known as Personal Capital. They have a great tool to check out your asset allocation, but there are other options out there. If you're a Fidelity customer, they have a tool called Full View that'll allow you to add accounts from other institutions and get a full view of your portfolio. There's also something called SigFig that I found in a Google search, and they have some paid offerings, but they have a free offering just to look at your portfolio and check that out. And then if you're a Quicken customer, of course, that's paid, but they do have in Quicken Classic some asset allocation and, really a lot of investment tools as well. But again, that's paid. And then, of course, if you're really old school, you could just build your own spreadsheet as well. So that's it. Just a quick little primer on asset allocation and portfolio composition. Hope you found that helpful. If you did, please hit the like button and consider subscribing. Thank you very much for watching, and I will see you in the next video.